had a very good discussion with Bill Halter. Bars are going to make you doubly susceptible to hoarding. In silver, you've got a slightly different structure. We had a breakout that was killed. Gold didn't get this far, and it never confirmed, and this got slammed. So silver looked like it was getting away out of the falling wedge, whilst gold and silver, there's always a liquid market for it. So it can sell off early only as the debt market gets more under duress. It very much seems that the way for, hey, a whole new money, we're going to restore faith, a big crash, a big cleansing, a big fire, and then after the storm, a whole new system. And conveniently, the public, with all their ETF buying through BlackRock, Vanguard, and State Street, which will have been providing cash to keep exit liquidity, possibly for a SpaceX listing and some AI companies as well, will then, after any crash, have a lot of data center supply that will be available real cheap for government to run a biometric surveillance grid with CBDCs.
What do you think will happen with the bond market going forward?
Gold bulls needn't worry, but
what are you seeing right now in gold?
Yes, thank you for that. And it's when we last spoke, I encourage people to have a look at some of the previous. We just warned that there's still potential for a third sell-off, and you tend to have sell-off in threes. It's kind of a structural number. A large amount of Elliott wave theory is built off, 5 waves in 3 selling and 2 rallies. And in essence, our 5,600 almost start. We had the big sell-off that brought us to 4.4 over here. We had a disbelief, very strong rally that took us all the way back to 5.4. Then we got that second sell-off that was actually almost bigger in gold, not so much so in silver. Silver got really hit the first time and didn't rally as far. So there was a degree of disbelief in gold. Gold went up higher. So the gold-silver ratio started to go back up again because gold outperformed on the bounce. But then gold got sold off a second time. We had another rally. This is a weekly chart, gold dollar. And since then, we've been grinding lower. We had an attempt to break out on silver that got rejected. That's this candle over here. I'll show you on silver shortly. And we're now in this weak and softening stage, and there is a possibility of the third sell-off. There's the 3 sell-offs in this continuation. We are still macro bulls. Let's be clear. This is a channel. The red line that I've drawn here, that I'll just double up, is the one we expect eventually to concede to the upside, but there's room for a sell-off first. Now, does it come all the way to the bottom? I don't know.
Markets are celebrating resilience in gold. Yet the chart structure still points toward unfinished downside risk. A third corrective leg is a pattern many investors ignore because the previous rebounds felt convincing enough to signal a bottom. What Francis Hunt is highlighting is that gold's relative strength versus silver may actually be masking weakness beneath the surface, particularly as the gold-silver ratio rises again. For wealth preservers, chasing momentum here could mean missing a better entry point if liquidity pressure returns. Next, Francis Hunt reveals why silver's failed breakout may be the bigger warning sign than gold's pullback.
If we had the AI bust, which we'll talk about later, potentially there could be a bit of risking off. But if not so, you could go to the halfway mark. But in the long run, we break for the upside. So gold bulls needn't worry, but we wouldn't be leveraged long trading now on gold. We're a long-term investor. Buying opportunities at lower prices may well present themselves. So something to bear in mind. I'll take you into the lower time frame on this. You might see there's a blue line there. There was a bit of a head and shoulder structure. In fact, I'm going to also pivot it just to gold Swiss because the dollar has become a little bit the story, but I'm choosing one of the stronger fiats to highlight a few small things. If I just show you this on a smaller time frame on the 4-hour, you'll see that this had a structural, and this is why we've not been too aggressive in getting back in any leverage basis. You got a little head and shoulder here on the lower time frames. This is why we say there's still a third sell-off. You had a bit of a rally here, and then you've just dipped. So technically, you've made that target for this little head and shoulder. It's not chronic. It's not a violent throwdown. You can see this absolute spit down. But it could get so if the rest of the environment goes down. There's been an adversarial relationship. Normally, gold and oil will go up together, weak dollar, commodity complex. we've got this element that I think has come about. China was aggressively stacking gold and silver, still is. The surplus nations to America were big buyers of precious metals, but they also import energy. So when we had the Hormuz crisis, which I feel is pretty much engineered, that ended up leading to a situation.
This setup looks eerily similar to periods when investors mistook consolidation for confirmation and got caught in another downdraft. According to Francis Hunt, lower timeframe head and shoulders formations continue to support the case for one more corrective move before a larger advance resumes. The overlooked issue is timing. Energy shocks can temporarily divert global capital away from precious metals, even when the long-term thesis remains intact. Investors focused only on central bank buying may miss how short-term liquidity needs can overwhelm bullish fundamentals. Next, Francis Hunt exposes why rising energy costs may have interrupted institutional gold demand at a critical moment.
Where the gold and silver bull got stopped in its tracks a little bit. That's when we had that big sell-off. Again, we can take it back up to the daily and you can be reminded of that. This is again on the Swiss franc, not the dollar now. We got our first sell-off. They needed to stop that, but they've changed their poison by bringing in the energy markets into this and having a very strong oil rally. The problem is, and I call it it's Trump's triangle of trauma. It's a trap in essence. They were failing, and we had the weird story coming out of COMEX, at a close of options that nobody really believed. That there was some real stress in the market with silver going up. Now we then got, okay, that got killed, energy's up, because that stopped the foreign nations that were buying gold to protect against the dollar and the bond markets, which is an important trade. It stopped them from doing that because many of those surplus nations are makers of goods, and they suddenly had to focus on energy supply with the Straits of Hormuz and a more expensive oil price. So they then have to go shore up and buy oil instead, and they cease to be a bid in gold. That's why why I would imagine we've had less industry, less hedge fund, central bank support for gold, and even some sales. Russia had to sell. You suddenly get a situation where they might need a little bit of dollars because still the bulk of commodities are priced in dollars. So that was gold. I want to run past the silver chart before handing back to you and just cap that. And then we can get into some of the other interesting topics that I know you want to have a look at. And again, on the weekly time frame, that's your falling wedge. So it's slightly different to, I showed you a channel on gold.
The official story says gold weakened because inflation fears eased, yet capital flows tell a very different story. Francis Hunt's argument suggests that energy costs, not changing inflation expectations, may have been the hidden force disrupting precious metals demand. When surplus nations are forced to prioritize oil purchases, gold temporarily loses a major source of support regardless of long-term fundamentals. That's a reminder that macro liquidity events often matter more than headline narratives pushed across financial media. Next, Francis Hunt unravels why silver's technical structure may expose a contradiction in the broader commodity story.
In silver, you've got a slightly different structure. The main part, there's your red line. That's the capping descending grind line across the tops. And we had a breakout that was killed. Gold didn't get this far, and it never confirmed, and this got slammed. So silver looked like it was getting away out of the falling wedge. That's the draw for the falling wedge, which is an upside continuation pattern. But again, we were warning, wait for the three sell-offs. You've had the first sell-off, and now again you've had the second sell-off. We're waiting for that third. That rejection is part of it, and I think you could come down before you eventually get up, utilize the opportunity at an investment level, certainly to stack. And then we have a break to the upside again. So this could again point up to some demand destruction as well. And that could see a lot of people selling whatever isn't nailed down, including what quickly gets a bid and is liquidated easily. Sadly, The good assets that are liquidated easily often get sold first. Property, for example, is not the kind of thing you just jump out of, especially a commercial property. Whilst gold and silver, there's always a liquid market for it. So it can sell off early only as the debt market gets more under duress, and people realize that metals are the ultimate foundation of money, not fiat and debt. We will see the bid come back in for the metals. So that would be my framing. There's still a potential for that third sell-off, and it depends a little bit on, are we going to have a rough ride? It's sell in May and go away. We've got a new Fed chief. He's sounding like he's going to ignore inflation, or have a new measure that measures it a lot lower. So he's going to try bring some heat, and probably because he knows he's got very fully priced assets in the stock market on his hands. Let me hand back to you though and let you just come in wherever you choose.
The assets people value most are often the first ones sold when liquidity suddenly disappears. This is where Francis Hunt's thesis shifts from technical analysis to capital preservation, because silver's failed breakout may reflect forced selling rather than collapsing conviction. History shows that during credit stress, liquid assets get dumped first, while underlying systemic risks continue building. Investors focused only on price may mistake temporary liquidation for a broken long-term thesis and position themselves incorrectly. Next, Francis Hunt reveals why debt market stress could ultimately become the catalyst that sends precious metals sharply higher.
So what do you think will happen with the bond market going forward?
I'll be giving my age away, but my investing career started in 1987, and I put all my money in the stock market with Alan Greenspan just taking over from Forker. And then I within a month. I was an August intake, and I caught the October 87 crash and lost, I think it was in one day the market was down 22%. So I had a baptism of fire in terms of my investment game. And so that was the first example of new Fed chairmans for me. And it has been a bit of a cycle, and I do reference it a little bit. But I love the way you juxtaposed faith. The issue of faith in monetary systems as a whole. You're seeing this loss of confidence potentially in crypto, as you were saying. And then we've also seen the bond market with rates gaining ever higher. There's much more queries about the sustainability of the debt markets. We can get a chart or two up there if you like. But overall, fiat and debt are very much synonymous. People don't always make this association. You can have a dollar in your hand that's a promissory note of alleged value. If someone else has confidence in it, it is not intrinsic, unlike gold. And a debt instrument is basically a dollar promised in the future with a small rental agreement attached, which is the yield. And we're having a loss of confidence in both of those, as we're seeing the loss in confidence in what I call gambler coin, like Bitcoin go up and down.
The bond market is flashing warning signs. Yet most financial headlines remain fixated on stock indexes near highs. As Francis Hunt points out here, rising yields are not just a rate story. They're a confidence story, and confidence is the foundation beneath every fiat-based system. The overlooked number is that debt servicing costs are now becoming a larger macro driver than inflation itself. For savers, this isn't an abstract debate. When trust erodes in debt markets, purchasing power becomes the casualty. Next, Francis Hunt exposes the hidden link between monetary distrust and the push toward fully digital financial systems.
And it very much seems that the way for, hey, a whole new money, we're going to restore faith, a big crash, a big cleansing, a big fire, and then after the storm, a whole new system. And conveniently, the public, with all their ETF buying through BlackRock, Vanguard, and State Street, which will have been providing cash to keep exit liquidity, possibly for a SpaceX listing and some AI companies as well, will then, after any crash, have a lot of data center supply that will be available real cheap for government to run a biometric surveillance grid with CBDCs. So it's I'm joining dots, maybe a bit ahead, and some of this may or may not occur, but I'm not a trusting type when it comes to governance and the money, because of the disassociation with the precious metal and intrinsic value. And of course, the minute you give people opportunity to have derivatives or proxies for money, they proliferate the proxy without having the value behind it to back it. And that's why we love gold and silver, Elijah, and that's why we are where we are. And you're absolutely right. The biggest trend is the loss of privacy in most things, and the other one is the loss of faith and confidence in monetary-based systems, both digital, the Bitcoin boom cycle, and I think the Bitcoin is almost the sideshow. It's about the stable coins and the transaction and digitizing money and getting an on-ramp to get everybody digital focused in terms of their money. I say hoard your cash until they make it illegal and stack your metals.
I think that is the trend, not just financially. It seems like people are losing confidence in the media, in the government, in institutions. Your take on that, and if we do see sort of a great reset or a central bank digital currency that
The Fed says confidence in the financial system remains strong, but public trust surveys have been moving in the opposite direction for years. Francis Hunt notes that the real battle may not be over cryptocurrencies or gold prices, but over who controls the rails of future money itself. The contradiction is hard to ignore. Institutions champion decentralization narratives while simultaneously building more centralized financial infrastructure. For investors, ownership of tangible assets becomes increasingly relevant when trust in intermediaries weakens. Next, Francis Hunt unravels how language itself can be weaponized against people seeking financial independence.
that could digitize everything. I guess I'm a bit maybe hopeful that the people won't go along with it. What are your thoughts on that? How much power do the people actually have, and how much can we actually protect ourselves against this?
So I was reading about the Roosevelt confiscation, and one of the methods of deriding people like us was to the use of the word hoarding. So typically, they said these, no hoarding and all of these things. And I want to mention a strategy that could help with this on both the bullion side and also address the opportunity in your question. But you will be scapegoated as a hoarder. And hoarders typically, when you have these programs, are selfish people that over consume a particular object and then do nothing with it. So it's kind of like I took all the toilet rolls out of the supermarket and filled my garage with them. It's unnecessary. I won't be utilizing them. I've forward purchased way ahead of my use case, and I'm denying others. So there's a lot of negative, and it's a very effective strategy of phrasing. What gold stackers really are not hoarders. We are advocates for sound money and seek to get rid of derivative proxy money in lieu of intrinsic value that we can control and not have an overlord control who is cheating and perpetuating fraud against us. So it's fraud protection. But watch for this framing strategy. So I thought, what's going to happen to me and you, Elijah, down the road when they want to stigmatize us and we haven't all been serfed to the, impoverished and now UBI required? They are going to attack the self-reliance. We'll become the new bourgeoisie of the Stalinist Bolshevik revolution.
This pattern has appeared repeatedly throughout monetary history. First comes the crisis, then comes the change in language. According to Francis Hunt, labels such as hoarding can become powerful political tools when governments need public support for extraordinary policies. The timing matters because narrative shifts often arrive before policy shifts, not after them. Investors who focus only on price charts can miss the social and political groundwork being laid beneath the surface. Next, Francis Hunt reveals why perceptions around precious metals ownership could become just as important as the metals themselves.
Where they chased the farmers and those that were middle class. They even killed a particular dog type because it was associated with the middle classes, a kind of Afghan looking dog. It was really cruel. And I think we're going to get that stigmatization again. And you already get it when you get these attack vectors on particularly white European, I see as that. So the resistance is you need to resist the phraseology of that, and potentially and we had a very good discussion with Bill Halter. Bars are going to make you doubly susceptible to hoarding. So coins, and in the US, you have a unique moment. Your junk silver is selling incredibly cheap, below spot. It's 90% silver, and the other 10 keeps it from tarnishing. So it's actually a very good investment right now. And your gold pre-33 era, your junk silver with the 90 is actually being given away. It's well below spot, and that is monetary coin. So you can't be, it's a bit harder to be a hoarder of real money, because anybody who's rich then is a hoarder of real money, which of course makes Nancy Pelosi, Elon Musk, all hoarders themselves. So maybe do that. I'm even thinking, because I've actually got 1,000-ounce bars, I'm actually thinking, make a bed frame out of it and sleep on silver. It's actually very therapeutic. Put a current through it or do whatever, but you might get some health benefits. But more importantly, you chose it's a furniture item. It's hard to confiscate somebody's furniture item, especially if you have a narrative as to why you have it. But bars could categorize you as a hoarder. So there's a little lesson on how they went about vilifying those that were protecting their wealth.
Nobody's talking about public perception risk, but it may become as important as market risk during periods of monetary stress. What Francis Hunt is highlighting is that ownership structures matter because governments and institutions often target behaviors before they target assets. The overlooked detail is that historically accepted forms of wealth can suddenly be reframed as socially undesirable when policy priorities change. Long-term investors should pay attention to how narratives evolve, because reputational pressure frequently precedes regulatory pressure. Next, Francis Hunt exposes why confiscation fears remain tied to incentives embedded deep inside modern debt systems.
Watch that and choose your categories wisely. Bars might make you doubly susceptible to confiscation, because I do feel the confiscation risk hasn't gone away. You were asking about, will they take the opportunity to do something more honest? And I just don't see it, because it would hamstring government on their inflation as policy ways, and inherently there's a ruling class and there's a patsy at the poker table, and we always have to be the patsy to fund their existence. So only people that are noble, Elijah, would be taking the opportunity to actually do something fair.
If this cycle continues for another few years, the biggest threat may not be inflation itself, but the policies designed to manage it. Francis Hunt's argument suggests that governments remain structurally dependent on monetary flexibility, making a return to stricter forms of money politically difficult. That's the contradiction many investors overlook. Officials praise stability, while relying on mechanisms that gradually dilute purchasing power. For retirees and savers, protecting wealth increasingly means understanding incentives rather than trusting promises.